Hello to all of you. Well, wonderful to have you all back, and I'm super excited tonight to do something that having lived in London for 9 years, for me, it's really an area that a lot of people should be looking at. A lot of people asked us at our last event. We had a lot of people come up to us and say, when are you getting London property? When are you getting UK property? And so I'm, really, really excited tonight to have four guests on with us, and we've got Simon Zutshi who's online. We've got Loren Williams who's online. We've got Craig Lardner who's online. We've also got Ken Williams who's online. And we're going to be going through, I'll introduce each of them in a little bit more detail. But we're really going to be going through tonight the UK. And what does the UK represent? Does it represent great risk? Does it represent great opportunity? What does Brexit mean? What is going to happen with tax? And, I think the only way to solve these questions is to ask people who are actually on the ground, who actually know what they're doing. And they're going to be sharing with you tonight not only their experience, but their perceptions on where they see the market going and some of these integral questions that we're all asking in terms of where the opportunities are. So from my perspective, what I wanted to do was just welcome everyone. Welcome to all four of you. It's wonderful to have you online.
Thanks, Scott.
Thank you. Thank you.
Thank you.
Hello. Hello all.
Hi.
We've also got people from all around the world. And so if you've got questions, please just up in the top right corner, you'll see the little question box there. Just type the questions away. What we're going to do is we're going to run through a format in terms of each one of the speakers or authorities, just giving you their perspective, and then we're going to go to a Q&A. So if you've got any questions, just type them away, and I'll be facilitating and running through that process in terms of where we're at. So without further ado, I suggest that we crack on. You should all be able to see my screen and hear us loud and clear. What I wanted to start with, just before we get into the UK, is that no matter what you read, and whether it's from Ray Dalio or Henry Paulson, two of the people that actually called the last crash, a lot of them are talking about how there's impending economic change over the next 2 to 3 years. Now, there's a great book called The Big Debt Crisis by Ray Dalio. It's free. You can go and download it, which I'd highly recommend. And what's really important is that people need to look at diversification. Now, whether that's diversification out of countries like China or South Africa into places like England, or whether it's English people wanting to diversify into America, it doesn't matter. It's still diversification in terms of what people are looking at. The second thing is that technology is deeply disrupting now both the banking and the financial industry. Simon, as an example, also runs a crowdfunding platform in England, and it's just reticent to what is actually happening. There was recently a 2.4 billion IPO in England, which was the first, fintech IPO in England. And then thirdly, what's really fascinating is that the last time there was significant transfer of value, wealth creation, was when they had the big bang in the stock market. And what basically happened is they cut out all the middlemen around the world, and the stock markets connected them with the internet, and people all over the world could now participate in the stock markets anywhere in the world. And it's actually happening right as we speak in the property, in the real estate industry. Then at a micro level, when one looks at it from a technology perspective, most people are stuck in country. Whatever country you live in, whatever city you live in, most people tend to be stuck in that country. They don't have access, to other opportunities. And whether it's Brexit, whether it's Trump, whether it's Zuma, or any other political interference, then people want to be able to look around the world and to be able to diversify. When they do that, the barriers are extremely high. They've got a lack of knowledge, a lack of money, a lack of time, and most importantly, they don't get access to the good deals. And then, when people start to look at it, it gets extremely difficult. You've got legal, banking, trust, compliance, the quality of the partners, the language, they all add to complexity that people don't have. Now, this is my first house that I bought in London in 2002, and you can see it's a little 3-bedroom terrace. We actually put 2 extra bedrooms onto that, and since the day we've owned it, it's paid us a passive income of over £1,000. So I was 24 years old at the time, and I really learned that this was a future that I certainly wanted to participate in. I will give you a bit of a side note for everyone that's online tonight. The boiler did burst in the last 2 weeks, and I just had to pay £3,800, which deeply pissed me off today. I literally paid it today, which sort of ties in with the next side of the story, which is that when I met a very wealthy man in 2009, he was investing in medical commercial, and he just opened my eyes to a whole nother world in terms of commercial. And I'm not saying commercial or residential, one's better or worse, it's irrelevant. What I think is beautiful now is that people can get to experience different types of investments. We asked ourselves a question. We said, how could we make global real estate investing easy? And when people think about global real estate investing, they think of hassles, management, maintenance, complex tax structures and bank accounts. And what we've basically done now on the Wealth Migrate platform is that you can get access within minutes to the best partners, the best opportunities. You can start to build a global portfolio. And the part I like most is you can get started from $1,000. And what that really allows you to do now is that, and obviously £1,000 if you're in the UK, what that allows you to do is focus just on the best returns. There's clearly a demand for it. We've got members now in 118 countries. We've done deals of over $500 million. We've had $79 million go through the platform, and we've paid out over $5 million in terms of dividends. Now, what's quite important is that for the purposes of tonight's webinar, is that technology is starting to disrupt the space dramatically. There's a lot of platforms all around the world, and Simon, I don't have your one up here because I was looking more at the equity crowdfunding more than the debt.
Yeah.
What's more important is that they are all very much in country. And we decided to ask ourselves the question, when I catch Uber, I don't want to have a different platform in every country I go to. And particularly when I'm starting to grow and build a global portfolio, the last thing I want to be able to do is to have a different app for every single country that I'm going into. And so we decided to build the global solution. And what is tonight about? Well, in simple terms, what our solution is about is that we work with the best partners. So we're going to hear tonight firstly from Simon. Now, I can't remember exactly when it was, Simon, but you and I started, I think the first time I met you was around 2005, 2006.
I think that's about it, Scott, yeah.
I'd started IPS, and I was effectively, and I don't even know what city we were in, whether it was Birmingham or Leeds. It was somewhere out of London.
London, actually.
Where was it?
I think it was London.
Was it London? So, we were on stage, and you obviously, doing your thing with I presume at the time UK property, and I was doing my thing with South African property. And it's absolutely fascinating that, whatever it is, 13, 14 years later, we actually, it was 2015, we both got invited to Necker Island. And we're both quite surprised because it cost quite a lot of money to be there. And we both were quite surprised when we were sharing a room together. So that was a certainly experience we can talk about for a long time. And obviously in more recent times, Ken has been talking a lot with yourself and myself around, what can we do? I think one of the things I'll let you talk about your own story, but you started I found this on the internet, Picken, the Property Investor Network, and
yes.
I'll let you tell the story, but it's the biggest property investment network now around the UK. And what that allows you to do is not only deal with all the investors around the country, but also really pick up on what's happening with the trends.
Yes, absolutely.
And then again, we're going to go to Simon. He's going to explain that in more detail. The second person that I wanted to bring up was Loren from Crestwood Property Solutions. I met Loren actually through one of our board members who actually invested in England through her. I spoke very highly of her. I went out and I did a check where I went on the ground and really looked at what she was doing, and has a really stellar track record in helping people buy residential properties in the sort of the London, I'll let her go into in more detail, but effectively the suburbs of London, very economically resilient because it's not dealing with the rich Russians or the rich Arabs that want the really top end property. It's the moms and pops, the workers that need to, help within the London context. And then the third person for me is Craig. And I met Craig through, I've known Ian Scott for a very long time, about 10 years. He's the managing partner of BDO down in Cape Town. And he actually introduced me to Craig, and I'm not even sure, it was probably at one of their presentations, Craig, that we also met. And I was absolutely, where was it, Craig?
I think that's a budget function they have every year. There's a great big function they do for the budget every year. And we hear the same story about how many people are paying tax and how people aren't. But we all go there because we sort of feel we're obliged to, But it was a great introduction.
And I mean, what Craig's referring to is there's about 400 and all the top property people in the country are actually there, and that's where we met. And what I was absolutely fascinating is that Craig runs a private, unlisted property fund here in...
private equity property fund.
Private equity property
fund is our terminology we tend to use, yeah.
And it's been highly successful here in South Africa. And then equally, I'll let him tell the story. But what I was absolutely fascinated by a couple of years ago when he introduced me to it was that he in the UK, they actually go out and they buy pubs and they renovate those pubs and they stick a Tesco's in it or a 7-Eleven. And again, we'll come to that. But I think you'll get a sense tonight. We've got three very different and diverse partners to give different perspectives. then when one goes to the platform, whether it's residential property or commercial property, it's on the platform, and the opportunities get listed on the platform. Then you and I, us as global investors, get to be able to participate and actually go and look at it. And then the final step is that we can sign up to the deals, we can select an investment, we can transact online, and we can manage our entire portfolio in one place. And so that's all for me from an introduction perspective. What I'd like to do, without further ado, is actually hand over to you, Simon. If you can explain, a little bit about who you are and what your background is, and really where you see the market at the moment. So I'm going to just change screens here and hand it back to yourself.
Okay.
Quickly. Should be coming up now. Wait, no, there we are.
Okay, hopefully you can see my screen now.
Yep, we've got your picture. Yep, we've got your screen.
Great. So welcome, Scott. Welcome, everyone else. And it's a real honour to be invited to kind of share some thoughts and opinions about the UK market. So who am I? Well, I started investing back in 1995, so 23 years ago. And it's when I bought my own house. And I basically rented out a couple of rooms to people who were still studying university in Birmingham. Well, I started work at Cadbury's, the chocolate manufacturer in Birmingham. And the rent they paid me pretty much covered the cost of my living, my mortgage and my bills. And so I started to save my salary. I had another business that I was running part-time. And so I was able to save up a deposit to buy a second house. So I moved out of my first home into a second house, and my friends came with me. I lived for free in that one as well. But the first one, I decided to rent to students. Students is a great market in the UK. A lot of the major cities have one or even two universities. And for the last 20 years, I've rented the same house to students. And I had this epiphany, really, if you like, that if you own property, it's a bit like owning a cash machine. At the end of each month, when you paid the bills and the mortgage and insurance and the maintenance and the management fees, you can have some money left over. So I look at property like having your very own cash machine. And if you have a number of these cash machines, you can actually replace your income. So that's what I was able to do in 2001. I left my full-time job at Cadbury's as then a senior manager. I hadn't quite replaced it all passively. Some of it was from holding property and renting, some was from flipping property. But it took me a couple more years to 2003, and I'd completely replaced my income from the passive income thanks to my property portfolio. So I was 8 years, and I was doing it very much on my own. I made a whole load of mistakes, and it was a pretty good time to be buying property, really. The market was going up, and anybody could borrow money. It was great. And then I realized actually how quite a lonely thing it was. And I was going to breakfast networking meetings we have in the UK, where you go and meet other businesses and you give referrals and things. And I met a great accountant, solicitor, mortgage broker, everything I needed for my property business. But the problem was none of them actually invested in property themselves. And the problem was they didn't really understand what I was trying to achieve. And all my friends were still working. None of my family invested in property apart from their own homes. So actually I was quite lonely. So I went online to see if there's some sort of group I could get together with and other people I could learn from, and there wasn't. So I set up the very first networking in the UK for property investors called the Property Investors Network. It was one meeting in Birmingham originally. It's now 50 meetings around the United Kingdom. So you have 50 meetings every month apart from August and December. And they're generally evening meetings where you can come and connect with local investors in the area. We have experts speaking at events, sharing their knowledge, and you can build up your power team. So it's a really great thing to have at grassroots. Now, the reason I'm telling you this is because what it means is I've got the ability to tap into 50 locations around the country where we can speak to investors who are at the coalface and get a really good view and an opinion of what the general sentiment is. And I can tell you there is massive uncertainty right now in the property market. I'll explain why that's happening, but that's the reality right now, and it's perpetuated by the press, but we see it at a very grassroots level. In 2012, I also started teaching people how to invest, because people said to me, how come you don't have to work? And I realized that's actually my passion. I love to teach people, especially when they go out and get great results. So I set up something in 2007 called the Property Mastermind Program, and it's a year-long program where we help people replace their income in a very short space of time, and we get incredible results. from that, in 2008, I wrote a book called Property Magic. Now, the great thing about writing a property book is it gets your name out there, get awareness. It's a #1 bestseller on Amazon. I think it's #1 today, which is great in the real estate section. However, because it's property, the property market changes. And I think it's very important for anyone who's investing to be up to date, because what worked a couple of years ago may not be relevant right now. So it's actually in its 6th edition. We just updated it this year, and it takes into account all the new changes of Section 24, which I'll mention in a moment, is some taxation thing that's come in very recently. And I'm still actively investing in property. I think it's very important. If I'm teaching other people, I need to be doing it. And frankly, there are so many great deals. When you know what you're doing, why on earth wouldn't I be doing it? And I tend to do larger deals. I tend to take things like care homes and convert them into smaller apartments and then rent them out or sell them on. And I've realized, but I started doing that back in about 2010. And I realized just how difficult it can be to work with traditional banks who say they want to lend to developers, but they don't really understand developments. And the more creative the deal, the cleverer the deal, the less they are wanting to fund, because they just don't get it. So in 2014, I launched a peer-to-peer lending platform called Crowd Property. So probably just a year or so, maybe after you, Scott, doing Wealth Migrate. Although Wealth Migrate is an equity platform, Crowd Property is very different. We'll never do equity, so we're not competing with Wealth Migrate, and we only really take investments from people in the UK at the moment. But we find great projects, development projects, and then we put them on the platform. We can fund the purchase and also the development costs. I have an MD running that business for me, and that's doing really, really well. We're fully FCA regulated, so I understand all about the regulations in the property world as well. So that's a little bit about me. So I'm still actively investing. I became financially independent at the age of 32. I love teaching because that's my passion, but actually still actively investing in property. And I think right now is an incredible opportunity. My book's also available on audio as well for the very first time, if you prefer that format. Now, I was at the London Property Investor Show. Ken came to actually come and have a meeting with me. We were talking about some interesting things we're looking to do here in the UK. And, a lot of people wanted to know what's happening right now. What should they do? And with Brexit coming, should they wait? And I'm going to answer those questions in the limited amount of time I have available here. There are 2 major things that are causing uncertainty in the market right now. One is Section 24, which is all you need to understand. It's a way that investors, they've changed the way that we are taxed as property investors. So what it means is anyone who owns property in their own name, which was typically the most tax efficient way to do it prior to April 2017, and anyone who's a higher rate taxpayer, so earning 45,000 or more a year, which most property investors are, because if you're doing it right, property should make lots of money. What it means is those people are going to pay more tax, increasing over the next 4 years. What that means is that we are seeing at grassroots level, at all the PIN meetings and the property shows we speak at, we're seeing that some long-term landlords are thinking about retiring early. Many of them, their exit strategy is to sell their portfolio and go and sit on a beach in a big pile of money drinking cocktails. And they're kind of saying, well, if I'm going to have to do the same amount of work, have the same amount of hassle and stress for the next few years, but my pay is going to go down each year for the next 4 years, it might be time to sell early. So we are seeing landlords looking to dispose of their properties. Now, what that means is that if they bring those properties onto the market, that alone, I think, will cause a slight dip in the UK property markets. And also, I think the other thing to be aware of here is if less people have rental properties available to rent, it will actually probably cause a rise in rental rates. So those of us who stay in the market are probably going to do quite well. What's really complicating this and causing an extra level of complexity is Brexit. So the UK is set to leave the European Union on the 29th of March. And the governor of the Bank of England, Mark Carney, recently made a statement saying that he felt that if there was no deal when the UK leaves Brexit, at the moment there is officially no deal, he said the UK could be plunged into an economic crisis as bad as 2008. Now, in 2008, the worst crash we had for a long time. In the worst parts, we saw property prices drop by 35%, and that was in Northern Ireland. Most of the country was about 20 to 25%. Interestingly, most of the UK is now back and above the peaks of 2007 before the crash. And actually, if you were to buy property in 2008, just after the crash and when everyone else was panicking and selling, there were some amazing opportunities available. And pretty much anyone who bought then has probably at least doubled the value of their property in the last 10 years. So what this means is, are prices going to crash 35%? Well, I very much doubt it. There was a totally different economic situation. It was all down to the toxic debt that banks had. They weren't lending money, whereas they've been very cautious over the last 10 years. They don't lend as much money, the loan to value. So I don't think we'll ever quite see that problem. But I do think prices are going to dip. But really, it doesn't matter what I think. It doesn't matter what you think. The general market perception is there could be a large dip. And so what that means is there are some sellers right now who are actually panicking and looking to get rid of some of their stock. What that means is it could be a great time to buy as long as you're holding for the long term. Not a good time to flip. If you want to buy and 6 months later the value might be less, that's not good if you're looking to sell. But if you look to hold for the long term, a really good thing. Now, I'd just like to very quickly tell you about the 5 golden rules I've used for a very long time to invest in property. I talk about them in Property Magic. The first one is we always want to buy from motivated sellers. People who've got a problem and we can solve that problem for them. Rule number 2, we only buy in an area with a strong rental demand. Now, that's really important because we want to make sure if the tenants move out, we can replace them with another tenant and keep that cash flow going, which is the third rule. We only buy for positive cash flow. You can make money short-term in property, but I believe the real wealth is holding for long-term. And then number 5 is you want to have a cash buffer, a little bit of money put aside to fix things that aren't covered by insurance. Now, relating these to the current situation right now, I think there are plenty of motivated sellers. I think you can negotiate really good prices. And as long as you're holding for the long term and it makes great cash flow, does it really matter if prices come down a little bit from when you buy them? I would suggest probably not, as long as you're not trying to flip property. So really what this means is there is an incredible opportunity right now. Now, there are existing landlords with portfolios who are very happy to keep them, but I think a lot of the people I know are trying to remortgage, they're trying to get cash ready. And this presents an interesting opportunity for investors in the UK and also for foreign investors. So I've been talking to Ken and Scott about what's one of the easiest ways for foreign investors to get into UK property. And stop me if I'm saying anything I shouldn't say here, Scott, but the intention is to find some investors who are really happy to keep their portfolio for a little while anyway, who are keen to release cash so they can buy more property if we have a bit of a downturn. It's just a big if. And there's an opportunity for Wealth Migrate clients to potentially come in to buy into those portfolios for a long-term hold, to get a return on their money and to get a stake in UK property without having to get finance and be able to buy in and have potentially shares that are tradable as well. And then the idea is to get a lot of portfolios put together and eventually sell them on to a commercial investor, kind of 50 million, 100 million pound portfolio, in the same way that Wealth Migrate has put together medical practices in America and then packaged them up and sold them on. So I think that's probably all I've got time for. But I'm not sure if you want to ask any questions around that, Scott or Ken. I hope that's given you a little bit of flavor of what I think is happening.
100%, Simon. I appreciate, love the energy as well. One quick question that's actually here from the group, because I know you can't stay for the whole time tonight, was that Hans actually said, is it a good time to buy real estate in the UK or should I wait for Brexit? So I think the point being is that, or the next expected turbulence of the financial market.
Okay,
of course,
let me answer that. And I would say that
what do you
if
expect?
you, sorry.
No, okay. So I was just seeing what the rest said. It's pretty much in line. It's pretty much saying, should I wait or should I take advantage?
Yeah, I would say, here's the thing. We don't know if the market's going to crash. And if you end up waiting, it might not crash because there might be a reason and it's just fine. It has certainly dipped. London peaked a little bit and it dipped. And I think really investors should not just look at London. London's always going to be a very safe, secure market. But long term, it will always perform well. But there are other parts of the country that also give a phenomenal return on investment. And as an investor, I'm always looking to maximize my return on investment on my cash flow. So London, although there are some benefits of it. Obviously, as long as you have the right local knowledge and you know what you're buying, there's some opportunities there. Now, imagine this. Let me ask everyone a question. They might want to kind of answer this. Is it easier to negotiate a really good deal when prices are coming down, or is it easier to negotiate when it hits the bottom and prices start to come up and everyone believes prices are going up? What do you reckon, up or down? And I'm pretty sure most people say, well, of course, down. So if you follow these rules, as long as you're holding for long term, and long term, I mean at least 5 years, and you've got cash flow and it's a strong rental demand area, I think absolutely you should buy now, because when it does hit the bottom, and I have no idea when that will be, it will start to come back up, and then people are not going to want to give you a discount. You're going to be paying, they're going to have a higher expectation of getting a better price than right now because they think the market's going up. So, you know, I think as long as you know what you're buying and you're steady about recognizing you might buy it, it might go down slightly short term, I would say now is a great time to get in, as long as you know what you're doing.
Perfect. Simon, thank you very much. I'm going to move over to yourself, Loren, if you don't mind. I'm going to share the screens. So you've been given, and we did this on purpose, you've been given a sort of a macro view from Simon's perspective. Hang on, I'm just changing the screens over. Let's move over to Loren. Okay, so we've been given a macro view from Simon's perspective. Now what I wanted to do was to move to Loren, and like I said to you, Loren actually is originally from South Africa, lived in England for about 20 years. I'll let her tell her own story, but started getting into property, if I remember rightly, in 2007. So she's pretty much in line with what you said, Simon, in terms of getting the timing right. And through, you know, basically the School of Hard Knocks has been doing quite a lot of property herself. And then, you know, a friend asked her to help, and then a friend asked a friend, and now you've got Crestwood Property Solutions that's helped a huge amount of people invest. And the thing I think that I find most interesting with what Loren's doing is that she does no marketing. It's all by word of mouth, which, you know, for me is a classic example of someone that's looking after clients. And it's not just helping them buy a house, it's helping them buy it, renovate it, and manage it. So it's the sort of the end-to-end solution. And I always tend to tell you, when you're wanting to look to partner with a partner, you want it all under one roof, because estate agents will tell you anything you want to hear. So over to you, Loren.
Hi, good evening, everybody, and thanks very much, Scott, for the opportunity to speak tonight. It's really quite a privilege, and about a subject that I'm really, really passionate about and have been for many years. So basically, I'm the owner and founder of Crestwood Properties Solutions. The company started in 2013, and it really started to find a solution to a problem that I felt many of my colleagues back in South Africa were experiencing, and that is, you know, how to invest in a country overseas. Where do you start? Who do you look to? What kind of complexities are involved? And it was really saying, what is the end-to-end solution that we would need to provide in order to meet a need in terms of people wanting to get their money out of certainly South Africa at that time. Interestingly, since we started, we now have investors from Argentina, from Australia and the UK. So it's quite interesting how the network of referrals keeps sort of extending its tentacles into different countries. So it's a great privilege to be able to help people all over the world. Essentially, you know, I think I have a very similar story to Simon in terms of why we started and where we came from. But I was an ex-management consultant, and I decided I needed to change my lifestyle quite dramatically. I'd been sort of traveling all over the countryside, working, you know, incredible hours, and I really came to a point in my life where I actually wanted something different. I wanted to be able to work, earn money on my own terms in my own time. And I did, as every sort of management consultant does, I researched everything to death and eventually settled on property. And I came across this little graph many years ago, not at the time that I was looking, but it really sums up the potential of property as an investment. And I think if you have a look at the comparisons that are on the screen at the moment, if you put sort of £50,000 into property in 2006, the the value of that particular asset would be around about 188,000 in 2016. If you compare that to other asset classes, it's quite significantly higher in terms of returns. And in my own experience, I think, that's very, very indicative of what I've experienced. So I actually invested in property in 2007, which was, you could arguably say the worst possible time to invest. We had the crash in 2008. It was an interesting experience, and as Simon says, I also have the sort of battle scars to show in terms of various sort of mistakes I made along the way. But there's not one day that I regret having made those investments. So even though the property market did crash, there was varying degrees of crashing around the country. And what was very interesting for me was I bought in different jurisdictions. I bought sort of up north in the UK, and I actually bought in the southeast, which is where we predominantly sort of focus. And actually the properties didn't fluctuate terribly in value in the southeast. They were relatively stable right through the crisis. As opposed to sort of further north, they lost quite a lot of value initially. But what was also good in terms of the properties up north was they really retained their, so the rental income remained solid and in fact increased. So the actual return, although on paper perhaps the investment had declined, the income that I was generating out of those properties remained very stable and has been very consistent since then. What was interesting for me in the southeast area was that the capital values remained pretty consistent and the rental incomes were strong right through the property crash. So in fact, as an investment, they did pretty well and have continued to do exceptionally well. And I'll show an example of this at the end of the presentation. But I think what's important is if you have a look at this graph here, the comparative returns are quite startling in terms of property versus other asset classes. And I got to experience this quite early on and thought, wow, this is something that I want to be involved in. It was on the back of the experience that I gained through my personal property investing that I decided that this was something that I needed to do for other people and to help people get on the property ladder in the UK. Hence, Crestwood Property was born. This is the area that we predominantly focus on. Why? Because firstly, we understand this area very well. There's a lot of dynamics that are important when investing in property, as Simon mentioned. I'll go through a few of those factors in a couple of minutes. But this has proven to be a very, very stable and a very consistent area for property investment. So we haven't seen sort of the massive sort of fluctuations that have perhaps occurred elsewhere in the UK. So the key to effective property selection and realizing sustainable returns is really a focused and target approach. And I think you really need to know the areas very well when investing in property. As we all know, there's in certain cities, there's certain areas where you wouldn't really want to be. So local insights, relationships, and knowledge are key. We also have access to pre-market deals, which is quite a nice situation to be in. After many years of having operated in the market, we get a lot of agents phoning us, with properties that come onto the market prior to even being marketed, because they know that we are reliable and consistent buyers and that we follow the process through. And I think that's really, really key. It's not the easiest process to buy a property in the UK. And a lot of property deals fall over. So that, we've at a point with the agent now where we are known to pretty much follow through on every purchase that we secure, which is great. Process management is absolutely critical. There are so many different facets involved in buying property, and each part of the chain needs to be quite well managed. And that's something that we do. We basically hold the hand of the investor right from the very beginning through to placing a tenant and actually managing the property thereafter. We also look for properties where there's potential to add value, and I think this is very important You know, sometimes you can buy the smallest, tiniest flat that looks absolutely beautiful, and that will give you a good, consistent return, but there's not necessarily the option to add value. And I think this is very important for our clients. So we sometimes, you know, look at the potential to add a loft extension, or perhaps turn a property from a sort of 4-bed property and split it into 2 flats. We also look at opportunities to upgrade an existing property, because often if they're pretty run down, you know, we can add quite a lot of value. So I think added value potential is very, very important. And ongoing asset management and maintenance is absolutely key. You know, those properties need to be well managed. Tenants need to be replaced very, very quickly if something goes wrong. So that what's important is that the value chain is managed very, very well, right from the initial sort of purchase offer right through to when you want to exit the property. And maximizing cash flows is certainly the primary aim that we have for our clients. So what are the most important things when looking for a property? And I think why we operate in the area that we do is the fundamentals are superb. So it's absolutely critical and absolutely key to the sustainability of the return, that the property is in an excellent location. And certainly what's good about the area in the southeast, certainly Kent, where we operate, is the excellent commuter links. It's very much in the sort of commuter belt to London, so access to London is very easy. You're looking, you know, well within under an hour in all the properties that we've selected for clients, and yet the initial capital requirement is a lot less than central London. So you're able to buy a much bigger property with much more potential in the sort of commuter belt than you necessarily would be able to in London. It also means that the rental returns are a lot higher than what you can achieve in London. Gatwick and Heathrow are easily accessible, and certainly the southeast property market has been pretty robust and pretty consistent in terms of performance. The rental values keep increasing, and they're increasing on average of about 3.5% to 4% per year. One thing that is particularly good about Kent is the excellent grammar and independent schools. Absolutely superb schools, and this is a huge pull and attraction for many young families, and for, in fact, parents with older children moving into the area. Properties in the grammar school catchment areas also command a slight premium and are known to be pretty resilient, pretty consistently robust, even in sort of downturns. And that's because people are not moving there specifically for a good buy. They're moving there because they want their kids to get into the very good schools, and yet they're still able to commute very easily into London. So location and proximity to public transport are critical, and all the properties that we've selected for clients are within half a mile to the station generally, with very good basic standard of accommodation. Plus, we also make sure that obviously that the management of those properties is well managed and well looked after. We've seen a softening in asking prices, not significant, I have to say, but there has been a slight softening. And what I mean by that is, you know, consistently over the last sort of 10 years, we've seen property prices increase in value in around about 10% per annum. I think the statistics that I was looking at recently, property prices increased over the last year by about 7%. So we've seen a slight sort of dip, but nothing that I would say is too significant. At the same time, we've seen, you know, rental incomes going up and rental values increasing still at 3.5% to 4%. So, and post the financial crisis, this area was particularly robust and pretty stable. Basically, you know, we have a major supply constraint effect on property in the southeast. There is insufficient supply, there's excess demand, and with those fundamentals in place, it means that the property market has remained fairly stable. So what are the things that are important when looking at buying property? Well, I think, you know, to have some expert on the ground knowledge is very important. As I say, you know, you could buy in one street and it's not nearly as good as perhaps 3 streets down. So location's important. I think stability of capital growth and income is important. And I think it's quite certainly comforting for a lot of our clients to know that we will assist and advise them right along the whole process. So we help them to find funding, which is one of the major problems. We have a couple of banks that we work with to provide funding to our clients. And we also provide access to solicitors and accountants, etc. So basically anything along the value chain of buying a property, any of the services that you may need, we certainly offer. We manage the tenant find, we manage maintenance, deposit protection, etc. We also are able to help with upgrades and refurbishments. As I said, we look for ways that we could add value to clients and to properties, and that might be through putting in a new kitchen, a new bathroom, etc. And that has proven to be, quite proven to provide quite significant sort of upgrade, increased value for our clients at the end of the day. We also provide the opportunity to exit and sell the asset at the end. So it really is sort of the whole value chain. So what are some of the tax changes and the impact of Brexit? In terms of stamp duty, obviously there was an increased stamp duty introduced for second homes. How did that affect our particular client base? Well, not significantly, to be honest. People, I think, who are looking to invest from international destinations are looking for certain stability. They're looking to provide a certain income for their children or in their retirement, or to fund university fees, etc. So whilst it's aggravating and it's annoying, it hasn't necessarily put them off. So it's not really impacted as significantly as perhaps we thought it might. There's an extra proposed stamp duty for buy-to-let investors. Not sure what's going to happen with that. Hasn't been announced as yet. So I think we've got to sort of wait and see. Simon talked a little bit about mortgage interest deductions that are no longer available to sort of higher rate taxpayers. A lot of our clients, for instance, don't fit into the higher rate taxpayer bracket because obviously the rental income is taxed in the UK. And a lot of them are not actually sitting in that bracket as yet. So it hasn't particularly affected them yet, but it certainly could do. Brexit, who knows? We're lovely to have a crystal ball to know what's going to happen with Brexit. Certainly there has been a softening of property prices in London. We've recently seen a slight slowing in the rate of increased asking prices in Kent. Certainly not significant, but definitely there is a slight softening. But I think prices are, again, primarily driven by supply and demand. So, who knows? As Simon said, I don't know if there's going to be a crash. Personally, I don't think so, because the dynamics driving the housing market are predominantly supply and demand, and there's an acute shortage of housing, certainly in the southeast. There's an acute shortage of rental properties. So we're still seeing, the rental values going up.
Lauren,
this is an example. Yeah.
Lauren, can I jump in there and just say, just put a slight caveat to that? I fundamentally agree with you. However, I would warn people, if they're dealing with partners like yourself that are finding existing properties, creating value, renovating, and sticking a tenant in, I think it's very economically robust. If they're walking into a hotel and some developers trying to sell them a new development, I would be very careful in the short term.
I agree, Scott, and I think I want to show you this example because this is a classic example of buying. This was bought by myself in 2007, right at the peak of the market. Property prices crashed in 2008, and I wasn't particularly worried because, as Simon said, I think property is you've got to look at it from a long-term perspective. I wasn't in it for the couple of years. This was at least a 10-year horizon for me. And I think, as you can see from the figures, the capital appreciation has been fantastic. The cash on cash return per annum has been fabulous. This was highly geared. I wouldn't suggest that anyone will gear at this level anymore because of the changes to the tax regime. But certainly, you know, the rental yield has gone up year on year. The rental value's gone up year on year. So all in all, you know, even though we had a property crisis in 2008, if you want to call it that, it certainly never affected this particular property. It was bought in an excellent location, very close to commuter links. It doesn't look like anything. It's very ordinary, but it's been a wonderful, wonderful cash machine. Again, what Simon was alluding to, you know, it has year on year just consistently returned, fabulous return, very little work needed, and yeah, it's been a wonderful investment. So, you know, that's an example, sort of 12 years later, of a property that I'm certainly not going to sell, that I will keep. This is an example of another purchase that we did for a Wealth Migrate client. This was a block of flats, actually. In this particular property, there are 3 separate flats. Again, we were able to secure this property at a very good price because the seller was a motivated seller, needed to sell quickly, wanted to get out of this investment for personal reasons, and we were able to snap it up quite quickly. So it was bought at quite a significant discount, so that we already factored in terms of value. It's been rented consistently ever since we bought it for him, with a 5.62% gross yield. The actual yield, you know, you might find a lot higher yields elsewhere in the country. What I would say about the Southeast is the combination of capital growth and rental yield is very, very good and very strong and very consistent. So you may get better yields elsewhere in the country, but you know, this area is very, very robust, and that's what I like about it. Is I can, you know, when I offer property to clients, I'm fairly confident that that's going to be a very, very good investment. So in terms of the returns, this one was geared as well. Obviously, that boosts your returns, but this particular property has been a solid income earner ever since it was purchased, and it's actually returned quite consistent and quite stable returns ever since. So I think that's just an example. It's a very bespoke offering that we offer. It's very personalized. So, you know, we work very closely with clients. We try and understand their long-term goals and aims. So they may be wanting to build that income to substitute for university fees. They may be looking for a substitution for pension earnings later in life. We try and really get a good understanding of what our clients' ambitions are, and certainly match their property, the type of property that we would select for them to those ambitions. And yeah, as I say, we've worked very closely with our clients and have been very, very fortunate to date that very much all of our clients have come through referrals. So it is something that we're extremely proud of, and we just really, try and work as hard as we can to do the best for our clients and problem solve when there are issues. I think that's what's important too. We certainly don't run away when something happens, and certainly, you know, problems do occur, and sometimes very unforeseen problems occur, and you know, we work through those issues with our clients. We'll never abandon them to leave them to try and sort them out in a 1,000 miles away. So that's really it. And thanks very much, Scott, for giving us the opportunity to speak to you. And I hope it's been informative. And if there are any questions, please do ask.
So, Loren, there are some questions, but we'll come to them at the end if you don't mind.
Sure.
I will say, just while I pivot to Craig, and I'm just going to get Craig's screen up here. When I was last in England, I was actually with Loren at about, it was 10:30 at night, and your tenant was coming over to pay your rent because they'd had some personal situation and they were paying it off weekly. And I was just quite surprised how hands-on you were, not only to look after the tenant, because I can't remember the exact story, but something had happened in their personal life. I think they were a painter or something, and someone hadn't paid them or so, whatever. But the point being is you were running a personal story. But what I found even more interesting is you were meeting them personally at 10:30 at night, which I was quite surprised by. So Just for me, it epitomizes your hands-on approach that you've just mentioned in terms of personalized. Right, so let's pivot. We've obviously discussed the macro of the country. We've focused on the residential. Craig, take us through a little bit of yourself, your experience, and the unique opportunity that you've also seen as a gap in the market within the UK side.
Well, Scott, I'm sorry, a bit of my non-technical knowledge. Do I just go onto my screen because I've on my computer?
You're on your PowerPoint. I just need you to go to.
So go to my PowerPoint and play that. Are you on now?
Yeah, we can see your slides. So perfect. We got you.
See your slides.
Yep.
So you are.
Absolutely. Yep.
Okay. So sorry about that, guys. Just a bit of a rookie error. Yeah. So thank you, Scott. And
we need that screen. Keep that screen on every time you change.
There we go. Back on. Okay, guys. So yeah, I'm going to have a chat to you about commercial retail property opportunities in London. What Scott asked me to do was just give a bit of a resume before we started. But essentially, I've been involved for 35 years in building property investment and development. I started my own construction company when I was still at university. And after graduating, I went up to Botswana and was involved in some quite serious capital-intensive construction projects for a multinational. In 1990, I started Procon in Cape Town, a property development company, which really specialized in residential, industrial, and commercial properties. It was multifaceted in that it engaged in procurement, construction, marketing, and financial structuring of various property developments. So really a one-stop shop. 94, I saw an opportunity in the UK, which I'm originally from, believe it or not. What I looked at was the residential opportunity in the UK for buy-to-lets, which we didn't even know what that name was in those days. But a lot of South Africans were wanting bolt holes to go to with the current situation in those days. And we started a very successful residential investment property portfolio for clients and moved on from there. It was really a good thing. In 2010, after all these developments and buy-to-lets and everything, we started getting out of construction and main development into what we called a Procon Property Fund, a private equity property fund. It was established to acquire income-earning properties, really for people who wanted to invest in commercial properties, focus in the commercial, retail, industrial sectors in South Africa and also the UK. People who wanted to invest in something that wasn't just going and buying, in all due respect to buying residential property, which I have no objecting to. A lot of people, A, are a little concerned about commercial, and B, don't necessarily want to spend the income or the amount of capital go into commercial, so they'd rather go into a little private equity fund, which is essentially what the Procon Property Fund is and still is today. Procon London is currently involved in convenience store property acquisitions, which I'm going to chat about in more specific detail. And in a sense, what I've always done for the last 35 years, and I'm echoing a little bit what Loren spoke of, is my skill set, I believe, has been value added to any property. I don't like getting involved in a property that is vanilla, that has got a wonderful lease with a corporate. I like something we can add value to and bring out the real guts of it. So going on to C-stores, we essentially, what is a C-store? What is the definition of a C-store? A lot of people ask me this question. A C-store is a convenience store, which is typically wholly operated by a supermarket public listed company, which is in a convenient commuter location where the emphasis of the consumer is convenience shopping. So come home from the city, come home from London to down in Kent, and get out of your car and go to your car park. Before you get there, there's a little shop on the side. It's a Tesco's Express. It's a Sainsbury's local. It's a convenience store. We colloquially call them C-stores. Recently, grocery multiples, they've moved very much to convenience, because traditionally convenience stores were moms and pop stores that were on the corner cafe, and they were very independent stores. Today, convenience retailing is growing at nearly 20% per annum. It's amazing. And 1 billion of sales So it's an incredibly important asset of a property asset to hold. And that is in the UK I'm referring to. Tesco's are clearly the biggest runners at the moment. They are, I think, something in the region of 26% market share. And one of the things that Tesco's has identified, which is quite, I like to look at because it's value adding, is they've taken the pub market, which is traditionally in the last 10 years, dropped in the UK. So these pubs that were originally owned by publicans and in the high streets are no longer used and they're empty. And they've converted into a C-store, and Tesco's is really targeting those. People like the Co-op, they're opening stores all over. They're probably one of the biggest growing guys, but they open in gas stations. They open in other places. Still, it's good. Waitrose are going big. Sainsbury's are trying to get a hold of stores down southeast and opening in London as well. Marks and Spencer's, Asda, Aldi, all these guys are climbing in on the C-store investment start. Many parts of the UK, hypermarkets are not accessible to people. So, a convenience store is a lot more of an opportunity for people to go to, and that's a lot of opportunity to get into in that market to get there. Another issue is that large supermarket hypermarkets can take up to 15 years to get planning permission from opening day, from planning to opening day. But the flexibility of convenience format makes the process far more easier. A pub in a high street has the same planning permission as a C-store. So by converting a pub to C-store, you don't have to go through this whole process. It's a lot easier to do. The other big thing with the C-store is that the weekly shop is declining in a major way. People are not going along to a hypermarket, loading up the boot of their car with a whole pile of shopping for a week or 2 weeks, and then going home and trying to load up a deep freeze in their house with a tiny little kitchen which doesn't have deep freeze. So a C-store is something they're far more wanting to go to. And from a personal point of view, I have a daughter in the UK. She's 30 years old. She's in corporate. She lives in the West End. She works in London. She goes to C-store 3 times a day, breakfast, lunch, and supper. On her way to work, she stops in for breakfast at the tube station, lunch with colleagues, and on her way home, she picks up food from the C-store for the home. So it's becoming quite an amazing area.
Craig, I remember you saying when you first told me about the concept, the average in the UK is that the average English person's going to a C-store 8 times a week. I think that was the number.
They say 9 times a week, average time 9 times a week, yeah. It's amazing. Originally you'd go every week, every second week for a big shop, but people just aren't doing it because A, cash flow doesn't really dictate it. B, they don't have a house big enough to have deep freezers. And C, they haven't got cars to go and load up boots with it. So it's an amazing situation that's happened there. But it really is, and there are a lot of opportunities in the UK at the moment for C-stores. Whilst there are a lot of them that pop up, might have leases, might not have leases. That's something to do with the acquisition. There are a lot of the clever boys out there that are arriving there and paying cash and not even raising finance on them. And exchange completion is like something that goes very quickly with a C-store acquisition. It's something that is just moving quicker and quicker. Yes, Brexit did give a big hiccup to it, but it is still something that, for me, is, I don't know, the largest attraction for me on the C-store opportunity is the fact that the Covenant is a listed company. And that lease is so important because your guaranteed rental income is going to come in. The covenant is normally 15 to 20 years. Sometimes a break clause of 10. The initial yield's around 5%. Depends on store location. If you go in the centre of London, you're talking probably 4.5%, 4%. The further out you go from London, the higher the yield goes. The other thing is the rental escalations are linked to RPI, the Retail Property Index. And the nice thing about that is that inflation, although it might be low in the UK, inflation is still linked to your escalation of your rental. And it's fully repairing covenant. So the tenant is looking after the maintenance of the place. It's looking after the the well-being of the places there, that their clients are walking into a decent facade. And the other thing, which is quite just a little blessing, is that rentals paid quarterly in advance. The reason is because for example, Sainsbury's or Tesco's PLC, the C-store rental is quite a low rental per month, and they don't want to have to do all the admin on it for 12 months a year. They'd rather do admin for 4 months a year. So they pay you in advance, 4 months rental in advance, and you've got a mortgage that is paid in arrears monthly. So your cash flow is a bonus. It's just one of those little added things. But for me, covenant is the biggest thing. Is the covenant. That's the biggest thing. This is a C-store investments. My structure model is based on a private equity property fund model. Can you see my cursor here?
Yes.
Yeah. So the investors are limited partners, as we call them, who they have circa plus minus 65% equity in the C-store investments SPV. If I go down to the bottom, that's the C-store itself. It's owned, and we open up a SPV, special purpose vehicle, for every single C-store there is. So an investor is only investing in a particular C-store, not in the whole group or the whole fund. And then the general partner is a 35% shareholder, and they raise and sign off the mortgage finance for the property. So the investor only puts in 60% loan to value is roughly what the banks are funding. So investor puts in, say, 40, and they put it in his loan account. It goes into the C-store's loan account. Procon acts as property investment advisor and property manager, and they look after the whole operation from an ongoing basis on the property management point of view. So what does an investor get in return? The investor, his loan account, gets interest paid quarterly in advance from the commencement of the C-store lease. His equity in the C-store investments is pro rata to the 65% plus minus limited partner share of the company. And the loan account in the C-store investments is paid back to the investor within 5 years with the interest, and they retain their equity in the unencumbered asset. Or if they wish to, they could sell out if they wanted to. That is an option they can have. That's the basic model that the Procon Property Fund operates in Cape Town, and that's how they go forward in Cape Town. It's a very simple model, but there is no encumbrance to the investor. He's got no encumbrance to the bank. That's where they're running. The management and the property investment package, I'm not going to go through all of this, but this is basically the standard stuff that any property investor will want their property manager to do on behalf of them for the operator of the company. And I just want to show and share with you the current developments that we're involved in. I think, Scott, you might have actually gone to this one. I think you did. It's in Richmond Road in Twickenham.
Yep.
Now, this was an old pub down the bottom here. And somebody has taken the top, and they have taken a developer, a residential developer, is wanting to develop this into residential. What we've done is we've managed to organize a lease through the developer of the bottom over here, and have got a co-op lease for a C-store to get into. Local authority permissions all in place, and the premises also got a license to sell alcohol now. Planning permissions ready to go for the shop front and get everything up and going. So things are looking good then. This is a little viability that goes with it. We've got a total of a 1.5 million acquisition fee, and we've got just under 5% initial yield on an acquisition. After 5 years, we're looking at about a 5.92% yield. It's in a proper area. The reasons that the yields are lower is because the area is very close to London. Twickenham Richmond Road is a good location. It's a nice spot, and again, it's one of these little pub things that gives story to it and gives some excitement to what your investment is. The other one we're involved in is in Sydenham. Sydenham is a gentrification area southeast of London. There are a lot of people, professionals, that aren't really affording to go and live in West End or higher end areas. And Sydenham is coming really in a growing area, again, value added. There's an overground that's recently been started in Sydenham. A housing, let me just go one back. a housing corporation has built these houses around it, and this was a listed building that was not allowed to be demolished. So it was originally a pub. In fact, it was one of the oldest pubs in England. And what has happened is that the builder is not wanting to get involved in C-store, want to just sell off his properties or the residentials. And so what Procon are doing is securing a long 99-year lease over the property, and we're getting council permission for the planning, and have engaged Sainsbury's, who've been waiting for 5 years to actually get involved in this area, but have not been able to because the housing developer just wanted to do residential housing. It's a little viability. It's a little bit less, but there again is value added here because this is a really up and coming area. This is 1.1 acquisition, and bingo, it's high yield, it's slightly further out of London. So these are the kind of things we're doing. We're excited about it. The biggest thing to me is value added. The biggest thing to me is that it's the covenant and the guaranteed rental income that we're going to have a situation where all the PLCs, as they call them, the Sainsbury's PLC is the guy paying you rent, not the Sainsbury's local. It's a PLC lease. So the strength of the lease and the strength of the security of your tenure and security of your income is just a no-brainer. For us, it's a great little idea, or more than idea. We've been working on it for nearly 3 years now, and we've been very involved in it, and we're looking at taking it forward right the way up. And I thank you, Scott, for letting us view the whole thing and be part of it.
Awesome. So I really appreciate, a very different perspective, Craig. Thank you very much. What I wanted to do was, I'm conscious of the time here, and I've got a bit of a poll that I want to put up for people, just to ask a couple of questions. And while I'm asking the questions, my partner is online, Ken, and he loves to talk as well. So I wanted to ask you a quick question, Ken, if you wouldn't mind. So while you're doing that, I'm going to chuck up the poll for everyone. So I'm going to stop sharing your screen, and I want to put up the poll. So Ken, just tell me, not from a property perspective, but with your background in investment banking, what do you think of the whole thing around Brexit and the UK, and sort of thoughts on the market at large? I'm not talking the market in terms of the property market. I'm talking just the economic market.
Yeah, thanks, Scott. So basically, what you've got to understand is that one way or another, we will get through this in the UK. Brexit, offers some pitfalls, but it also offers an ability for the UK to negotiate with 2.2 billion people in the Commonwealth, as opposed to the 500 million in Europe. You've got to remember too that we are discounted here in terms of the currency itself. And just to go back to what Simon was saying, he likes to buy at a good point in the cycle. You must remember that we've turned in terms of the credit rate cycle here. We've had a couple of raises. We still at tantamount to lowest ever. And looking at mid-cycle rates in this first turn, the expectation really is that you're only going to get to a quarter of mid-cycle rates at best. Basically, mid-cycle, let's say 4%, half of that is 2%, half of that is 1% at best in this rate turn. What it does is it offers a boost to the currency, and obviously you're investing in hard currency assets. So, the way I see this, and again, I think all three presenters have alluded to the fact that if you know where to go, it offers you with a great opportunity.
Excellent. So what I'd like to do now is sort of open it up to the floor. And hang on, I'm going to close that poll, and I'm going to move everyone back over to myself. Give me 2 seconds. So I should be coming back to see my screen. And I'm going to open the next poll. And what I'll do while we're doing these polls, oh no, sorry, that wasn't what I want to do, is basically give just people a chance to sort of let them know what they think about. Loren, there's a question for you from Ian Botha Botha, saying, given macro expectancies, how do How do you go about in preparing and advising your clients accordingly?
Can you hear me now?
Yes, got you clearly.
Oh, hi, sorry. In terms of most of our clients, as I said, we work quite closely with them to understand what their sort of long-term views are. Certainly, you know, in terms of Crestwood Property, we don't have a crystal ball in terms of what's going to happen within the economy. What we do is we look a lot at the past statistics. We look at the performance in terms of property in various areas, and we look at the consistency of returns. And that's why we focus predominantly in the area of the Southeast, because the long-term trends and the long-term capital growth has been consistent and has been positive for many, many decades. And I think that's what's important. We also look at fundamentals such as supply and demand. And certainly in the Southeast Kent area, and pretty much all over the UK, actually, there is an acute shortage of, I mean, there was a report that came out the other day that suggested, you know, there's around 240,000 houses that need to be built in the next couple of years. And they're certainly just not able to keep up with the demand. The developers are not producing enough residential homes at this stage. So you've got this unique situation of, you know, a very small country, really, with a very large population and very limited land supply and a very strict planning regime. What that means is that it's not that easy to get planning permission to put up new residential homes. There are many constraints that affect the supply of property, and as long as those situations exist, the supply-demand dynamics will drive property, and the consistency of property returns in the UK is what I believe. You will get, you know, short-term blips as a result of sort of political factors, but it's primarily the supply and demand factors that actually drive the market.
Scott, can I chime in there if you don't mind?
No problem.
I just wanted to offer this as well for Ian's benefit, is just in support of what Loren said. You've got basically a need on a residential, from a residential perspective, for the building of 300,000 houses a year. If you just have a look at Q3 in 18, they produced 38.7 thousand houses, and that's 4% down from Q2. Now, if we just roll that up and actually call it 40,000, and you annualize that, that's 160,000 houses. That's only just over half of the requirement. So, you know, it just demonstrates that there's an acute shortage here.
No, wonderful. Thank you, Ken. So I'm not sure who wants to answer this one, and maybe Loren, this would be better for you, and then the next question I'll go back to yourself, Craig. The question is, should one be investing in London or other areas? You know, it's a question I get asked all the time and have been asked for nearly 20 years. What would be your take on that, Loren? And when I say other areas, I'm not talking sort of, you know, your sort of areas. I'm talking Leeds, Bristol, Birmingham, you know, Manchester, whatever.
So I think certainly London is not an area that we advise our clients to buy in at the moment. And the reason for that is I've personally felt that London prices were overinflated. I've been sort of advising clients for the past 5 years that I thought, you know, prices were going to come off in London. They have proven to do that. I'm not sure how much longer the sort of down cycle in London's going to last, but I think, you know, London prices were propped up by many sort of Russian and Chinese investors pumping money into London specifically as almost sort of trophy assets. It was an unusual situation, and I think something that couldn't be sustained. So London, certainly in terms of rental yield as well, I wouldn't recommend to clients. So I would probably steer clear of central London at this stage. I think there are some good buying opportunities up in Manchester and Leeds and places like that. I think you're getting higher rental yields. The only slight concern that I have in areas like that is it'll be interesting to see how they ride a downward cycle. And I think whilst you may get good yields and much higher yields potentially than you're achieving in sort of case at the moment, the stability of those returns may be affected by a downturn. I can't say for sure, but certainly when we had the crash in 2008, Middle England and Northern England were far more significantly affected than the commuter belt around London. So properties lost, I think, as Simon said, around about 35% value. We certainly didn't see that in the commuter belt, or certainly not in the Kent area. But I think it's really up to the investor in terms of, what their ambitions are. If they're looking for very high yield, then I would suggest probably up north. They might be able to achieve higher rental yields. If they're looking for a more consistent sort of balance between capital growth and yield, then I would suggest perhaps the commuter area around London might meet their needs better.
It's interesting you say that, Loren. Sorry, Ken.
Scott, it's Craig. Can I make a comment?
Yeah, go on, Craig.
I want to echo Loren's sentiments on the commercial front. I fully agree with Loren's sentiment that going up to Manchester, Leeds, you might get a better yield. On the commercial front, I said earlier that the yields are always smaller the closer you get to the centre of London in C-stores than are further out. But again, echoing Loren's, it depends what the investor wants. Do they want to have income yield, or do they want to have capital growth? And I'm only referring now to commercial, to C-store. On a personal front, I would personally rather have something that is closer to London with the capital growth, because exit strategy on a C-store, after 15 years, the C-stores aren't around. What you're going to do at the property in the centre of London is a lot you can do. But if I'm sitting out in Wales, or if I'm sitting up in North Midlands, I'm pretty bugged. If I'm actually down in Kent, I'm happy. I'm sure we can find something there, but I'm a bit of a southeast sort of bias. So I do think that it's really up to the investor. What are they looking for? Income yield or capital growth? And remember exit strategy. Remember exit strategy. What are we going to do to get out of this thing? If you're going to go into it, you've got to learn how to get out of it.
Well, I was also going to back up Loren. I actually spoke about it in this book that came out in 2014, and my first experience in England was we did everything in London, and then I went to one of those big property shows in Excel, and it was all about the yield. It was all about up north, and I can't even remember where it was, like Bradford or something. and I was going to get these huge returns, and that's when I learned the hard lesson of the difference between a real return and a paper return. And what I found is those very low income sort of areas, on paper they look hell of a good, but the difference between the maintenance and the costs and the money that actually gets put in your bank account versus the paper return are significantly different. From experience, that was, I got rid of them quite quickly because they didn't really work. Craig, just a quick one from your side, and then if anyone else has any, there's a couple of more questions that have come in, but I'm conscious of time here. But what about the risks, Craig? It's interesting. In life, people always want to look at the upside, and someone of your experience who's been doing this now since the early 90s, it's all about looking at the risks as well. What sort of risks are people, should people be aware of, or that you are looking out for and managing when you're investing?
Scott, I've spent my entire life borrowing from banks. Unfortunately, I didn't come with a trust fund behind me. So I've had to make use of how to go and borrow from a bank. And I was taught this at a young age from a banker when I was still a student, is that when you go to borrow from a bank, tell them how you're going to pay it back, because they're in the business of lending money. And when they want to lend you money, they want to get paid back. So the more you borrow from them, the more you pay back, the more they'll give to you. So I've since subsequently developed a little phrase that I go into any scheme. When I go into a C-store scheme into London, going into one of the banks, or if I'm doing this commercial scheme in Cape Town, before I start asking for the money, I tell them what the product is and what is the exit strategy. How are you going to get out of it? And how you're going to get out of it is not necessarily paying the bank back, but to know where you're going to be going. So to answer your question, the risks, you need to have your covenant, your lease is so important that you need to know you're going to get paid the rental to pay your mortgage, to pay your investment. So for me, you know, answer your question about the risk to me is all in what is your covenant? What is your paper? What does the paper look like? If we've got Jack Spratt, you know, all due respect to him, I don't know if we're going to get our money. But if I've got a PLC company who signed up and is paying me quarterly in advance, I'm pretty confident my risk is pretty secure. And the term of your lease is also important. And again, I mean, it's not a comparison to residential and commercial properties. They're all very different structured and very different models that you're involved in. But I do believe that covenant, and what I call colloquially, I call it paper. If you've got good paper on a property and you've got a decent residential tenant in Tunbridge Wells that you've got down there, Loren, you know you're good. But if you've got someone who's not paying you rent on the 8th or 10th or 12th of the month, you've got a problem. It's simple as that. It's all about covenant. That's, to me, the risk is your covenant in property, because you want rent. We're in the business of collecting rent. We're in the business of getting rental return. How do you do it? You got to get rent. You know, some people make shirts and they're in the business selling shirts. We're in the business of collecting rent. That's my answer. Is very simply put, the risk is your covenant.
Ken or Loren, do you want to add anything to that?
Yeah, I think, you know, I think as I alluded to in my presentation, it's absolutely vital that you are in areas with strong rental demand. And obviously, you know, what's good about the Southeast, I would say, is firstly the quality or caliber of tenant that you are able to attract is generally fairly good, because the areas are fairly good. An example was today we went to look for a particular client in a particular area. They've got a limited budget. So we were forced to sort of extend our search a little bit further. And I actually said to my partner, you know, I can't recommend a property in this area because I'm not sure of the quality of tenant that we can attract. So we went going back to basics, and we're starting to look again in an area where we feel comfortable that, you know, we're going to get a good quality of tenant. So absolutely, you know, there are risks associated with residential tenants because, you know, things happen, people's circumstances change. We try and minimize that as much as we can where possible. I can honestly say we, you know, over our portfolio of properties, we've had very few defaults. We have had some, but we've had very few defaults, and generally the rental income has been pretty sound, pretty solid, and pretty secure. We're also able to replace tenants very quickly. On average, it's 2 to 3 weeks void before we actually able to place a new tenant, and that's simply because there is so much demand in the area. A lot of properties actually we're able to run smoothly from one tenant to the other with no void period at all. Very much depends on the location and obviously the value at which we are pricing that particular rental property. So yeah, I think, you know, consistency of rent is obviously important, and that's why there's certain areas that we won't target, because we're not very, very confident that we're going to be able to place consistent tenants. Then I think we'd rather actually walk away.
Perfect. Okay. I wanted to share some things just quickly. If anyone's got any other questions, they can post them. The first one is that I really recommend this website, acadata.co.za. It's effectively used to be called Academic Metrics, and it's a really good place to find all the information with regards to residential property. And every month, so they come out with the latest index. So because we're in the middle of October, the September one will actually be coming out quite soon. But it's something I've used for nearly 20 years now to really get an indication on what's happening in the market. So I just wanted to share that as a really good source of information that I'd highly recommend. In terms of what we've spoken about tonight, you know, you've got incredibly good partners like the three that we've been going through, whether you're looking at residential or commercial, whether you're looking at equity release or new developments, you know, and even what I didn't talk about tonight, you know, was I said there when I did the survey, some sort of buyers sort of fund. There's a really good opportunity, particularly with, you know, things we've been talking about with Brexit and everything else, would be ultimately to put, you know, some sort of vulture fund together, and, you know, where the money's in the account, because I can guarantee you, Loren and Craig would both agree that if the money, and Simon would if he was still here, that if you've got the money in the account, your negotiating power is just so much better when you've got proof of funds. And so something we're looking at doing is actually being able to pre-fund so that the money's in the account, and then we could actually invest more. So things that you're interested in, like equity release or in the buyer's fund or whatever, just type it in the chat box in terms of where the process. But hopefully you can see that the purpose of our marketplace is to get the best partners in the world, to get the opportunities, to allow you to get access to them, and then for you to be able to use the platform to be able to facilitate them. In terms of the next steps, you can literally go on to, online to Wealth Migrate. Richard Payne's asked a great question, how the partner is going to leverage off the Wealth Migrate platform. Well, in simple terms, someone like Loren helps people invest in direct properties. So we're going to be able to have her opportunities on the platform for people that want to invest directly in a single family or a single house or apartment. But what we're also going to be doing with Loren is taking down apartments like the one that she showed, whether it was 3 apartments or 10 apartments, and then people can participate. Obviously, from Craig's perspective, with regards to the commercial properties, we're effectively going to be partnering with Procon, and they can bring those type of opportunities to the table, and we'll be investing alongside and partnering with them. And with Simon, Ken's been doing a lot of work with him on these portfolios of investors who want to do equity release, where they wouldn't be selling the building, but we would effectively be investing alongside them. So I don't know, Richard, if that answers your question, but really the purpose of tonight was to show you the caliber of just 3 partners in the UK. And as we grow out the marketplace, we really want to give people lots of opportunities. There are people that you can speak to from an investment consultancy perspective, and Craig's going to know much more about the C-stores than I will, or anyone in the Wealth Migrate team. So if people do want to speak to him, we can put them in contact. If you want to speak to Loren, we can obviously put you in contact with Loren, etc. And then for me, it's all about getting started and ultimately becoming a global citizen. I put up there a couple of things to talk about. I've been investing in the UK since I was 24 years old. And mostly that I say to people, the reason I do it is because it provides me with wealth preservation, a plan B, and peace of mind for my family. A lot of my colleagues and my friends my age have now immigrated, trying to look for a passport or whatever. I believe it's far better to become a global citizen. I've got a British and an Irish passport, but that's not really what excites me. What excites me is the fact that I've got first world assets with a first world income that allows me to become a global citizen. And I think that's really, really important. Through the platform now, I've been helping people invest in England since the early 2000s. And originally, even now, if you take one of Loren's properties, even at £200,000, you would need at least a deposit of probably 30% probably, Loren. I'm talking like aggressive.
40%, I'd say, yeah.
Even 40%. So, you're talking £80,000 on a £200,000 property. What I love about the technology component is that, through the platform, people can now participate, from £1,000. And so it really starts to give people access to it. The question is, can I get a passport if I invest in the UK? My understanding is no. You can't buy a property. It's not like Mauritius or Cyprus or Portugal. You can't buy a property and get a passport, but you can certainly use it as one of the most financially robust places in the world to invest, to keep growing your global asset base and become a global citizen. And, for me, becoming a global citizen is what it's all about. And if you want to look at some extra value adds, we've got the CEO letter. Just type in their CEO letter if you want more information, and we can share with you how we see technology morphing and really working with you. We've got the investor test. If you're a beginner investor or if you're super qualified, it doesn't matter. It helps you know where you are. It helps you know what you need to do next so that you can create the personalized path to wealth. And, for me, what we're doing in terms of the micro degree, what I've just spoken about now in terms of becoming a global citizen and how to become a global citizen, it's literally there, in terms of the micro degree. I will post the links for people, or you can just go on our Facebook page and actually get access to it. Literally, the Facebook page is Wealth Migrate. The inner circle is really what we're doing tonight, with partnering with some of the best. And then the masterminds is where we're going to go really deeper. Ken's speaking directly with Simon Zutshi at the moment around some joint collaborations. And so if people are interested in the masterminds, just type in their inner circle, where we'll go deeper with our partners like we're doing tonight. And then obviously the masterminds, which is a 12-month program on how to become a global citizen and set yourself up for success. And then the last thing that I'm super excited about is that our new marketplace is actually launching at the end of November. And so the purpose of tonight was just to show you 3 of the, in my opinion, some of the best partners in the UK, and the type of products that we're going to be bringing to the platform over the next couple of coming weeks, and you'll be able to seamlessly invest in them. And then the last thing that I think is quite exciting, and something that Ken has been working on hugely, is first is the opportunity to be a wealth partner, to actually become a shareholder in the platform. And this is a great slide where we're actually changing the way that the whole thing actually works. So previously people were only able to invest in companies once they went to IPO around sort of Facebook or Amazon. And a lot of people know there's been huge value created in Uber and Airbnb and the likes, but you had to be a venture capitalist and that to be able to participate. And really what we're doing now is we're partnering with the biggest equity crowdfunding platform out of England, a group called Cedars, and that'll allow people to actually participate and become shareholders in the platform. So if you think what we're doing is good, we literally will be launching the pre-reg campaign in the next couple of days. So watch the space. Make sure you're on our social media channels, and we will certainly let you know. And you can become a shareholder within the platform. And I tend to remind people that if you had invested $10,000 at the IPO stage of Amazon, today it would be worth $12 million. And that was at the IPO stage. We're still talking way before the IPO. So the question I've got for you: don't you think it's time that we created a Amazon of real estate where you can get access to the best opportunities and use technology to invest? So what did we do tonight? Well, we started off with Simon talking about Brexit and the tax changes that are happening, and the property investor network and his access to investors all over the UK and the equity release. We then moved to Loren and her explaining something I found fascinating was actually moving out of management consulting, very high paying London job, moving out of that to go full time into property because of not only her personal experience, but also because of the returns that she showed, that it's outperformed any other asset class since 2006. Then we moved to Craig, and he went through his experience from the early 90s being in property. I think, Craig, you and I studied the same thing, to be honest. And what was fascinating is that, not only evolved in terms of doing London residential property, but then going into the commercial property. We showed you how, you can literally now be looking at residential or commercial property, how you as the investor can actually participate, and then the 4 simple steps in terms of the property and what you're looking at. And the last thing that I'd like to say is that we are going to be doing a survey over the next couple of weeks. And thank you for everyone that filled in the poll, because we're really asking people to dare to dream. Where would you like to invest? If you could invest anywhere in anything from any amount, what it is that you would like to invest in? And so, watch the social media spaces. Let us know what you want. It's fascinating tonight seeing what people want. And the more you tell us what you want, the more we can go out there and get it in terms of what we're doing. So, that's our Dare to Dream campaign in terms of what people actually want and where they want to go. So in conclusion, before I take the last couple of Q&As, this is my wife and son at a very young age of 5 years. He's playing Global Monopoly, and he's earning at a very young age to own green hotels and red houses and earn a passive income is what we call smart investing. His father, with an incredible team, has taken a childhood fancy of the game of Monopoly, turned it into a global reality, and now allow people, like my own family, to own a diversified portfolio of residential and commercial property across the world. And that's what we call smart investing. The wealthiest people in the world, they focus on creating generational wealth, not just individual wealth, but generational wealth. And it's what we call smart investing. And we truly believe that now is the time to put smart investing in every single person's pocket. And so, I've got a huge amount of respect for everyone that's been online tonight. I really, really appreciate, Craig and Loren and Ken and Simon and their time. And it's wonderful to have you. If you guys have just 5 more minutes, there's a couple more questions that I wanted to answer, and then we'll wrap it up. Are you okay for time?
Yeah.
So just quickly here, Piers asked, if we invest in UK property projects, what would be considered a good IRR? So what would you consider a good IRR? I don't know, Loren or Craig, if you want to answer that, or Ken, all three of you.
Sorry, Scott. Can you just repeat that once more, please?
What would you consider a good IRR in the UK? So what is a good?
I think on commercial, I'd like to see north of 10.
So north of 10%, yeah?
On commercial.
Yeah. On
I'd say on residential, we're probably achieving between 15 and 20%, depending on the actual investment.
That's very good. Very good indeed.
Okay. And I think Pierre's comparing it to other markets like the US, where you're getting sort of 14 to 15%. Again, Pierre, we need to compare an apple with an apple, because it's like comparing Atlanta to New York is like comparing Birmingham to London, and it's quite important just to take that into account. So when comparing an apple with an apple, you need to compare countries, cities, asset classes. I certainly believe that there's a huge amount of value in diversification across not only countries, but currencies and asset classes in terms of where we're looking at. In terms of the percentage income, the cash on cash, both of you had a cash on cash. Loren, you had a cash on cash. I can't remember the percentage off the top of my head.
Yeah, so I think in terms of rental income, cash on cash is generally around about between 4.5% and 5%. And then in terms of the potential capital growth or value uplift that we're achieving, around about 11 to 15%, depends on the project, depends on how much needs to be done to the project, and it depends on how highly geared it is as well.
Okay, wonderful.
Yeah, commercials 5% on your cash on cash is what you look at. The further out you go, it might be a bit higher, otherwise it's slightly lower. And on your geared up value, you'd be looking, because you're not going to get more than 60% on geared up value. If we're looking at around, again, something around between 10 and 12.
And I think, again, just to be clear here, you've also got to compare an apple with an apple. You are dealing with publicly listed companies, and some of the stuff I've seen with you, Craig, has been as high as 20-year leases. So it's really quite important, from an economically resilient perspective.
If you're referring to Cape, to the Western Cape Property Fund, that's a whole different ballgame. There we're talking up to 18-20%, but then we're talking a very different ballgame in South Africa. We are talking the United Kingdom. Again, it's all about covenant. Yeah.
Well, Craig, it's not for tonight's conversation, considering it's UK Extravaganza, but we do hope that you will be joining the platform on the South African side as well, and giving people opportunity to invest in the quality opportunities here. So look, from my side, I think that that's enough for tonight. Again, I deeply appreciate your time, Loren. Ladies first, I really appreciate Craig, you sharing your knowledge, and Ken, as always, your macroeconomic views. Simon, I thought, brought some great energy to the table. If you are interested in the stuff that I've shared with you, just sign up to the platform. If you're on the platform, then we will be communicating with you over the next couple of days and weeks around these UK opportunities when they're launching on the new platform. We will be sharing with you the inner circle and the masterminds. We're also sharing with you the Seeders campaign. I'm super excited. We should be getting the video tonight. I can't wait to see it. And so if you're on the platform, either on our social media platforms or signed up as a member on the wealthmigrate.com platform, then you will be getting access to this information. But other than that, that's all from me. Thank you for your time. And it's wonderful, in my opinion, to have the UK up and running again. I think that it's just the tip of the iceberg of what is possible in England. And these economic disruptions actually present a tremendous opportunity. The 3 people that have been, or the 4 people that have been on this call tonight, have all said that it's an opportunity. There's at least another 10 people that have come to me over the last 6 months and said there's a significant opportunity growing in England. And, the one thing that I've learned about property investment or real estate investment is that it's about timing, but you've got to have the partners on the ground to have your finger on that pulse. So good night, and thank you everyone very much for your time.
Thank you.
Thanks very much.